Welcome. In today's lecture, we will study payout policy and capital structure in practice. Today's topic connects two decisions that are often taught separately. The first decision is payout policy, how a firm returns cash to shareholders. The second decision is capital structure, how a firm finances its assets using debt, equity, retained earnings, and other sources of capital. In real corporate finance, these decisions meet in the same room. A firm with extra cash must decide whether to reinvest, hold cash, pay down debt, pay dividends, repurchase shares, or make acquisitions. A firm without enough cash must decide whether to reduce investment, reduce payout, borrow, issue equity, sell assets, or use reserves. So, the central question is very practical. How much cash can the firm return to shareholders while still preserving the ability to invest, manage risk, service obligations, and maintain financial flexibility? That is the heart of today's lecture. Payout policy is not just about being generous to shareholders. It is about building a sustainable financial policy that supports strategy, discipline, and long-run value. Let's begin with the two most common ways firms return cash to shareholders: cash dividends and share repurchases. A cash dividend is a direct cash payment to shareholders. It is usually viewed as a regular distribution, especially when it's part of an ongoing dividend policy. Shareholders receive cash because they own shares. A share repurchase is different. The firm buys back its own shares from shareholders who choose to sell. After the repurchase, fewer shares remain outstanding. Selling shareholders receive cash and reduce or end their ownership. Non-selling shareholders continue to hold their shares, but they now own a larger percentage of the company. Both dividends and repurchases return cash, but they feel different to investors and managers. Dividends are often interpreted as a continuing commitment. Repurchases are usually more flexible. Managers can adjust the amount, timing, or speed of repurchases as conditions change. The payout measures you see on the screen help organize these ideas. But remember, accounting earnings and cash availability are not the same thing. A profitable firm may still need cash for working capital, fixed assets, acquisitions, or debt repayment. And a firm with temporarily weak earnings may still have cash reserves, although that cannot support payout forever. The key lesson is simple. Payout should be judged by sustainability, not just by appearance. Dividends are powerful because they communicate stability. Many investors like predictable cash income, and many firms understand that. This is why managers are often careful before increasing regular dividends. A dividend increase can send a positive signal. It may suggest that management believes future cash generation is strong enough to support a higher recurring payment. But the same logic also creates risk. A dividend cut can be interpreted as a negative signal, even when the cut is financially responsible. This is where dividend smoothing becomes important. Managers often avoid changing dividends every time earnings rise or fall. Instead, they adjust gradually. They want to avoid sending confusing messages and avoid committing to a payout level that cannot be maintained. The most important distinction is between permanent cash flow capacity and temporary cash availability. A firm may receive cash from a one-time event, such as an asset sale, a tax refund, a litigation settlement, or an unusually strong year. That does not automatically justify a permanent dividend increase. Regular dividends should normally be funded by cash flows the firm expects to generate through normal operations over time. Temporary or irregular cash may be better handled through a special dividend, a repurchase, debt reduction, or simply holding more liquidity. So with dividends, the question is not, can we pay it today? The better question is, can we keep paying it responsibly? Now, let's turn to share repurchases. Repurchases are attractive because they give managers flexibility. A company may receive authorization to repurchase shares, but that does not mean it must immediately complete the full amount. The firm can respond to market conditions, cash availability, regulatory limits, investment needs, and financing constraints. Repurchases also change ownership in a different way from dividends. With a dividend, all shareholders receive cash equally per share. With a repurchase, only selling shareholders receive cash. Continuing shareholders remain invested and own a larger percentage of the firm because the share count has been reduced. You will often hear that repurchases can increase earnings per share. That can happen mechanically because fewer shares are outstanding. But here is the warning. Higher earnings per share does not automatically mean value has been created. If the company uses cash to buy back shares, it now has less cash. If it borrows to buy back shares, it now has more financial risk and higher obligations. The accounting result may look attractive, but the economic result depends on the full financial picture. So the critical question is not, will the repurchase increase earnings per share? The better question is repurchasing shares the best use of cash after considering investment opportunities, debt capacity, liquidity needs, valuation, and risk? That question moves us from financial appearance to financial substance. Now we need a benchmark idea. Payout irrelevance. In a perfect capital market with investment policy fixed, the method used to distribute cash does not change shareholder wealth. This does not mean payout is meaningless. It means that under ideal assumptions, value is not created simply by choosing dividends instead of repurchases or repurchases instead of dividends. Think of payout as moving cash from one pocket to another. Before payout, the firm holds operating assets and excess cash. After payout, the excess cash leaves the firm and goes to shareholders. The firm is worth less because it has less cash, but shareholders now hold that cash directly. With a cash dividend, the stock price adjusts downward after the dividend because cash has left the company. The shareholder has a share worth less than before, plus the cash dividend. With a repurchase, cash leaves the firm and the share count falls. If shares are repurchased at fair value in a frictionless market, continuing shareholders own a larger percentage of a smaller equity value. The lesson is subtle but very important. Payout irrelevance does not say managers should ignore payout policy. It says payout policy cannot create value merely by changing the form of distribution under perfect market assumptions. For payout policy to matter, real-world frictions must be present, and in practice, they are always present. Real markets are not frictionless. That is why payout policy matters. Taxes can make dividends and capital gains different for investors. Some investors may prefer dividends. Others may prefer repurchases or retention because capital gains may allow more timing flexibility. Transaction and issuance costs also matter. If a firm pays out cash today and later needs external financing, it may face underwriting fees, legal costs, advisory costs, bid-ask spreads, covenant negotiations, or unfavorable market conditions. A payout that feels attractive today can become costly if the firm has to reverse it soon afterward. Signaling is another important friction. A dividend increase may suggest confidence. A dividend cut may suggest pressure. A repurchase may suggest that management believes the stock is undervalued. But investors will ask whether that signal is credible. Agency considerations also matter. Excess cash can tempt managers to invest in low-return projects, expand for the sake of empire building, or avoid capital market discipline. Payout can reduce cash under managerial control, but excessive payout can also weaken the firm and increase distress risk. Investor preferences matter too. Some investors want stable income. Others prefer capital appreciation, tax deferral, or reinvestment. Finally, financing constraints matter. A firm with uncertain access to capital markets may preserve cash rather than distribute it. So in practice, the same cash payout can have very different consequences depending on taxes, timing, leverage, market conditions, investment opportunities, and risk. Payout policy must be evaluated together with investment and financing needs. A useful way to think about this is the sources and uses framework shown on the screen. The message is simple. Every dollar of cash has a job. Cash paid to shareholders cannot also be used to fund investment, reduce debt, or preserve liquidity. When free cash flow is strong and investment needs are limited, payout may be natural. When valuable investment opportunities exist or financial risk is elevated, retaining cash or reducing debt may be more appropriate. This leads to an important principle. Payout should generally be residual after funding positive net present value investments and maintaining a prudent capital structure. In other words, the firm should first protect valuable investments, necessary debt service, liquidity reserves, and financial flexibility. Then it can distribute excess cash. But practice is more complicated because firms often smooth dividends. Managers do not want to cut regular dividends whenever cash flow temporarily weakens. So they may set regular dividends conservatively, at a level that can survive normal downturns. Then, when cash balances rise above strategic needs, the firm can use more flexible tools, such as repurchases or special dividends. This tension between residual payout and dividend smoothing explains many real-world policies. Dividends are often designed for stability. Repurchases and special dividends are often designed for flexibility. The best policy recognizes both goals, credibility today and adaptability tomorrow. Let's now shift to capital structure. In practice, firms usually do not target one exact debt ratio. They target a range. That range may be expressed using market value leverage, debt to capital, debt to EBITDA, interest coverage, a credit rating goal, or a combination of measures. No single ratio tells the whole story. Market value leverage responds to market prices. Debt to EBITDA compares debt with an operating cash flow proxy, but EBITDA is not the same as free cash flow. Interest coverage focuses on interest payments, but it does not fully capture principal maturities, capital expenditures, working capital needs, or refinancing risk. Because of this, managers often use several guardrails at once. They may consider a target credit rating, a maximum acceptable probability of distress, leverage ranges consistent with peers and lenders, minimum interest coverage under normal and downside scenarios, limits on near-term debt maturities, liquidity targets, and flexibility for acquisitions or unexpected shocks. A target range is more realistic than a precise number because business conditions change, market values move, interest rates change, investment needs evolve, financing windows open and close. A firm may temporarily move above or below its target range after an acquisition, recession, asset sale, equity issuance, or major investment cycle. The important issue is whether managers have a credible plan to return to a sustainable range over time. Capital structure is not about hitting a perfect number. It is about preserving strength, discipline, and strategic flexibility. Debt capacity is the amount of debt a firm can support without creating unacceptable distress risk or sacrificing valuable flexibility. Debt capacity depends on many factors: the stability of cash flows, the tangibility of assets, the cyclicality of demand, the maturity of the business, future investment needs, and the credibility of management's financial policy. Credit ratings matter because they influence borrowing costs, investor access, covenant terms, supplier confidence, customer confidence, and the firm's ability to refinance during stress. For firms that depend heavily on capital markets, a rating target can be a strategic constraint, not just a label. Financial flexibility is valuable because the future is uncertain. A firm with liquidity and unused borrowing capacity can respond to downturns, fund growth, acquire assets, and withstand disruption. A firm that has already used most of its debt capacity may be forced to cut investment, issue equity at an unattractive price, sell assets quickly, or renegotiate with lenders. Industry differences are also important. Firms with stable cash flows, tangible assets, and predictable demand can often support more debt. Firms with volatile cash flows, intangible assets, and high growth opportunities often rely more on equity and retained cash. But peer ratios should be used carefully. They are useful starting points, not automatic targets. Two firms in the same industry can have very different risks, strategies, customers, assets, and access to capital. The better question is not, what leverage do peers use? The better question is, what leverage can this firm support while funding its strategy and surviving plausible downside scenarios? Firms do not raise capital in a vacuum. Interest rates, credit spreads, equity valuations, investor risk appetite, market volatility, and sector sentiment all affect the cost and availability of financing. These conditions create financing windows. Debt may be attractive when credit markets are receptive, maturities are available, spreads are reasonable, and lenders offer flexible terms. Equity may be attractive when the firm's valuation is strong, investor demand is high, and the company has credible growth opportunities. Repurchases may be attractive when management believes the shares are undervalued and the firm has excess cash after protecting investment capacity. But market timing should not replace discipline. A firm should not issue debt simply because debt markets are open if the result is excessive financial risk. A firm should not repurchase shares simply because the stock price has fallen if the decline reflects weaker fundamentals or if cash is needed elsewhere. The best time to raise capital may be before the firm urgently needs it. Waiting until distress is visible can reduce bargaining power and make financing more expensive or unavailable. So let us finish with the big idea. Capital structure is not a one-time calculation. It is an ongoing managerial policy. A sound policy connects four decisions: invest in valuable projects, maintain prudent debt capacity, preserve liquidity for uncertainty, and return excess cash in a form that matches cash flow stability and shareholder needs. Thank you for watching. I hope this lecture helped you see payout policy and capital structure as one connected financial decision. I will see you in the next video.